There's the run of the 3,000, slam really hard at that point. But it didn't get follow through. In fact, something else coincidentally occurred at the same time. Decide for yourself. We had peak tariff tantrum. This was when Trump was going to tariff the world. He was fighting with Europe. He was fighting with China. He was fighting with everybody. And suddenly there was a mass disposal of US assets. The bond rates went up. However, instead of the usual hegemon events, the dollar crashed on that bond rates going up. And this was a sudden fruition of a prophecy we gave in 2022 in September, when we said the following: what happened for Liz Truss and Kwasi Kwarteng is going to happen for America. And you got a small peak, microcosm event of that. Suddenly, he backed right the hell off. At that moment that the dollar absolutely spilled violently, and we'll bring up the Dixie, we'll bring up the dollar just to show you that. In fact, it's story best told with the journey, where people can see the footprints in the path. So if we're going to go long form on this and just go where we are, because there's a bit of a shock and a twist coming here. So if I pivot you to gold, I will remind everybody that we said this is one of the most important small HVF structures right here in the blue. And many people were sleeping on this particular breakout. They had suffered the indignity of a high at 2021, and they'd seen nothing but downside. The promise of the golden elixir, every time we just ran the 2K, downside. Just ran the 2K, downside. And we said once, twice, three times, fourth time a lady, like the Lionel Richie song. You may remember that. It's kind of a catchy phrase thing we use. And it goes with technical analysis. And we said this is going to turn into a winding up structure. This low leg was at $2,011. That was just after you were sitting on top of the 2,000 support. By the way, you can see the dark blue over here. Maybe I should get my traditionally popular transgender pink out instead. It pops a bit more.
Once gold crossed above the psychological barrier of $2,000, bullish momentum accelerated. Traders aiming for $2,900 to $3,000 saw their targets hit, driven by a broader structure that hinted at continuation. The move wasn't just technical, it mirrored macro chaos. During Trump's tariff conflicts and global economic instability, the dollar plummeted even as bond yields surged. This dollar decline amplified gold's rally, fulfilling forecasts made as early as 2022. As markets spiraled, gold soared in a moonshot to the $3,000 zone before being violently rejected. A classic Elliott wave ABCD pattern started forming, and technical caution flags were raised.
And I know you're all rooting for me to do that in Marxism times. Anyway, so when we had this set up, we said, listen, you're probably going to do a 293,000 run from here. Not only will you get the upside of this particular target, which I think was around here, you're going to stay largely going up right the way through, because this is all part of, and then we drew this larger, so we have patterns within patterns. This is how you build wealth, by the way. You multiply your way in there. You use a small pattern to break into a bigger one. And the leg, the flag-like leg, this is a broadening structure. It's not a channel, but the flag-like leg was giving us the 2,900-3,000 vibes. You can see those are the two zones there, 2,900 and 3,000 targets. And we said, that's going to be a good run. And then at some point, we need to take the temperature to see what's happening from there. And that was a very accurate and good call. We aren't always accurate. We aren't always going to be golden. We're talking about the future. Please remember, on balance of probabilities, we're scenario casting what might happen in the future. That was a great run that we had. There was long, strong periods. There was very short gestation periods, long, strong periods. Again, another squeeze, which we utilized. And here, I want to get into the key bit, because we're in uncharted territory, and we ran the 3,000, so that was our target. And we say typically you get a bit of progress decay. There's the run of the 3,000, slam really hard at that point, but it didn't get follow through. In fact, something else coincidentally occurred at the same time. Decide for yourself. We had peak tariff tantrum. This was when Trump was going to tariff the world. He was fighting with Europe, he was fighting with China, he was fighting with everybody. And suddenly there was a mass disposal of US assets. The bond rates went up. However, instead of the usual hegemon events, the dollar crashed on that bond rates going up. And this was a sudden fruition of a prophecy we gave in 2022 in September, when we said the following: what happened for Liz Truss and Kwasi Kwarteng is going to happen for America. And you got a small peak, microcosm event of that. Suddenly, he backed right the hell off. At that moment that the dollar absolutely spilled violently, and we'll bring up the Dixie, we'll bring up the dollar just to show you that.
The rally stalled near $3,500, with gold unable to sustain its breakout. What seemed like a new leg higher suddenly reversed. Price declined sharply, a steep rejection that technical analysts couldn't ignore. Retail traders jumped on symmetrical triangle patterns, hoping for $4,000, but the price action betrayed the optimism. Gold's rise had become too crowded, with bullish sentiment peaking. The steeper the support, the shakier the setup. Buying on every dip became mechanical, lacking conviction. The pattern that once looked like a breakout began resembling a trap. Alarm bells started ringing among analysts watching momentum evaporate.
We got a moon shoot. So this was at our target of 3K, 293K that we had predicted. You got a super spike moon shoot to 3.5. A logical round number as the midpoint between the 2000s. It got stamped on there, down, rally, down. A classic A, B, C, D structure, sort of Elliott wave structure. And then there was a bid at 3,120. So this is the story so far, what's happened. Initially, we came into this, we were super bullish. We, those that are bias bull, fundamentally and technically, we're in an upside trend. We want to be bullish. Then typically debt markets collapsing, we want to be bullish. My big concern now is we were very much in the minority down here on this structure. Everyone was, oh, another dime at $22,000 again for gold, just run it, fall back down again. It was quite out there to be that bullish at that time. And to talk of a 50% move, don't forget, you're at 2,000. You traded 3.5. That's well more than 50%, but our targets at 3 were represented essentially a 50% move. And you got the typical amount of overperformance thanks to the tariff tantrum and the politics and the collapse in the dollar. This last blow off, this little turbo final pop over here was actually a function of the dollar and everybody suddenly waking up that debt is a problem.
Gold's rally mirrored something deeper, a collapse in trust in debt markets. Since the 2020 bond surge during COVID fear, we've warned that the 40-year bond bull market was ending. Recent moves confirmed it. Analysts like Luke Gromen and Stanley Druckenmiller openly questioned the future of U.S. bonds. Instead of treasuries, capital began flowing into gold. But when Zero Hedge started echoing this narrative, concern rose. When mainstream financial media echoes early contrarian calls, risk often follows. Substitution into gold was no longer niche, it became consensus. That shift brought new instability, especially as retail flooded in late to the move.
Now, we made a call in 2020 September on debt markets, and we've said a lot of things. We said the 40-year bull is over, and that was outrageous. Everybody was, buy bonds, wear diamonds. Raoul Powell said it, all the other traders were saying it. You just had a major surge. Bonds had never been more valuable. This was, of course, the stock market crashed, Bitcoin crashed, a whole bunch of things crashed in CV19, as you know, and all that money ran into the fear trade, which was debt markets. And we very shortly after that in September, so that was all March of 2020, said, actually, we've turned. And the pattern structure of that debt market is where we are now in gold. So I am initially going to shock everybody by saying I'm deeply uncomfortable with the way we got rejected on the last run. We thought there was a break. So I'm going to drop the time frame and I'm going to take you into gold because it's quite important everybody listens. because it's going to cause a lot of hate. All our stackers, everybody are going to come out. They're going to want to beat up on me now. I am a long-term investor in precious metals. I am a sound money advocate, but technical analysis is technical analysis. Here's what I've noticed. Luke Gromen, lauded in Zero Hedge recently last week, good analyst, by the way, talking about how there's a big substitution of bonds. The best explainer kills it, how the bonds are being sold off for gold. This got a lot of Zero Hedge. Now, by the time my technical trades start to get acknowledged by somebody else, because we are the Cassandras of this market, it's usually a concern for me. This happens countless times. Zero Hedge and other financial media. By the time they're talking it and bragging it.
With prominent voices now calling for $15,000 to $20,000 gold, optimism reached euphoric levels. But history warns us, when sentiment gets too bullish, reversals often follow. Price began to grind upward sluggishly, forming a wedge that felt forced. Technicals hinted at exhaustion. Our previous bond market short pattern, once ridiculed, looked eerily similar. The rising base and flat top was a red flag. Instead of smooth breakouts, gold was faltering. Worse, rejections were becoming stronger and faster. Momentum was no longer organic, it was reactive. The technical setup was now warning of a deeper pullback ahead.
We were saying since the end of 2020, quarter 3, quarter 4, September kind of bridges the two, that this is a substitution. Now other people running with our messages are now getting lauded. We also had Stanley Druckenmiller saying they short bonds, that didn't say they were buying gold, but I imagine they might be. All of those things. We've had George Gammon, Clive Thompson all come out and say on YouTube that they're going to potentially re-rate to 15,000. George Gammon said to 20,000. All of this. This is only bullish, and this is all debt bearish, what Luke was saying, and gold bullish in the mood, and it's making me deeply uncomfortable. Then we got the technical price behavior that was going on here. When this we thought was a breakout, and we went and we were lauding it, and we were laughing, and we were also cocksure, etc., and happy days, we were net long here. Over there on a breakout, and it had fast-paced momentum. It was going all right. The subsequent, here's what happens when you're a technical analyst. When any time something out of the blue happens that is disproportionately unexpected and high momentum, stop and think again. And this rejection, there was something wrong with this. I've got to say, there was something deeply wrong with this. We look at the rejection from the 3.5, that's the rate of decline. We look at our secondary rejection. If this was walking out and squeezing into volatility. The other thing happened on Twitter, everyone's drawing symmetrical triangles and has been following me for a while and is now going gold 4,000. And I'm going, too much of retail, all in this space. So all the sentiment indicators are making me nervous. I now draw the rejection to the low there. That is a steeper line of rejection. We don't like this. This was a bit of a flag-like grind up, and the hardest pattern to spot was our bond call short. And I'm going to tell you that this technical pattern looks exactly like that. And what tends to happen, because I spoke in the community and I mentioned it once or twice on YouTube.
Some believe a gold revaluation to $15,000 or beyond wouldn't spark inflation. That's dangerously naive. A revalued gold price implies a devalued dollar, driving up prices across commodities like silver, copper, and even food. A monetary reset through gold would trigger waves of inflation, not stability. As the world flirts with central bank digital currencies and mounting debt crises, speculative energy around gold grows. But technical analysis tells us to proceed with caution. The recent rejection suggests gold's path is not yet clear. We may still go higher, but only after the excesses are flushed out and reality reasserts itself.
This buying line along the bottom was a bit steep. Typically, we like to see more symmetry. It's kind of flat along the top, but a bit steep along the bottom. So what tends to happen is more and more people have got the script and it says, buy gold on dips. So they're coming up under here, buying gold on dips. Coming up under here, buying gold on the dips. This leads to it being a bit high. Coming up under here, buying gold on the dips. Coming up under here, buying gold on the dips. Eventual breakout, complete fizzle back. It shouldn't have happened. I thought everything was hunky-dory. We're off to the races. 3,800s, 3,750s were a target, etc. Typical upside HVF breakout draw. Then I watch the selling and I go, this isn't right. It is hard, it is strong, and it's violent. Then I think of my reset. We're going into Q3, Q4. It's August coming, September, October. We've got a CBDC launch. We've got everyone bullish and talking about revaluation upside. By the way, small sidebar. Somebody who spoke of that revaluations to 15,000 said it wouldn't be inflationary. It absolutely would, because if gold's going to go to 15,000, silver would move in the private markets, even if it is not by decree remarketed, up to its ratio. You would get a similar move in platinum. Semi-precious metals like copper would have to move. And actually, rather than being a gold-based reset of price, it is an acknowledgement of a dollar-based debasement. That's what would happen. And you would actually start to see softs going up and you would get inflation. It's not a free 3.9 trillion to get. So I disagree with that particular person. So we've got too many people all expecting by decrees we're suddenly going to get a moon shoot. This started excessively to worry me. When I combine it with this price behavior, I'm going to show you our call that we made in the bonds and why I call them similar. Also, when you look at a big time frame on technical analysis, you start to see that actually you were a little bit higher in the middle. So I've just gone up a time frame. I'm just going to take some of the draws off. It's a bit messy. You can see this was quite a big shooting star, but at the candle levels, you were higher here, but you didn't go higher generally. This is more rounding out. So this was a bit of a superfluous, unique event on a spike that didn't hold. There was a baby's breath at 3,500. Forget trying to have sold at that point. You were very unlikely. It's probably negligible volume.